start investing $300 a month at 25 instead of 35, and you don't just retire with a little more. You retire with $1.2 million more. Think about that for a second. It's the exact same money, the exact same return. The only difference? Starting 1 decade earlier. That's really the whole core of this explainer, boiled down to a single sentence. And honestly, it's pretty wild how almost nobody acts on this in time. So here's what we're gonna do over the next few minutes. We're going from absolute zero investing experience straight to your very first real investment. We're gonna cover exactly what account to open, what you should actually buy, and how much to put in. And stick around, because at the end, I've got a simple 3-step starter blueprint. It's literally the exact sequence I'd hand to a total beginner. But a quick heads up, if you just skip to the end without getting the reasoning first, that blueprint isn't gonna make much sense, so definitely stay with me here. All right, let's talk about your checking account. If you've got money just sitting there right now, you're using maybe 1% of what that cash can actually do. Here's the math that nobody really shows you. Imagine you leave $10,000 in checking, right? Earning basically nothing. Well, with current inflation rates, that $10K is only going to be worth about $7,800 in real purchasing power a decade from now. It's literally losing value. But take that exact same $10,000 invested at the stock market's long-run average and be worth roughly $26,650 in 10 years. Even after you adjust for inflation, that's still about $20,800.
So, same money, same 10 years, but a massive $13,000 gap. And get this, that is purely from just moving it from one account to another. That's not just some helpful little tip, that's the entire reason we are doing this explainer today.
But, knowing why we invest is really just the entry fee. What you invest in matters so much more. And honestly, this is where a lot of beginners kind of get it wrong. I mean, you've got real estate, gold, collectibles. There are literally 100 ways to invest your money. But stocks? They win for beginners for one beautifully boring reason. They are liquid. You can buy a share in the morning and easily sell it that very same afternoon. Try doing that with a house. I mean, you can't exactly sell your guest bathroom just because you need some quick cash for the weekend, right? So let's look at the S&P 500. This is basically a collection of the 500 largest public companies in the US. Now, historically, it's returned about 10.3% a year on average since 1957, and that includes dividends. But quick gut check here. That average? Yeah, it is not what any single year actually looks like. I mean, 2022 alone was down almost 20%. So average definitely doesn't mean a smooth ride. It just means that if you stay in long enough, the good years absolutely outweigh the bad ones. Now, sure, you could try picking individual stocks. Some people do it really well, but picking one single company means you're betting everything on that one company's future. And let's be real, some of those absolutely go to zero. But an index fund, it never does. Why? Because the index itself automatically swaps out the losers for the winners every single quarter. You aren't betting on just one horse. You get to own a tiny slice of all 500 companies, and you just let the index do all the heavy lifting and sorting for you. It's just a fantastic safety net. Okay, so knowing you want an index fund, that's step one. But if you don't know exactly where to put that money, like which account to use or even how much you're legally allowed to contribute, you're kind of stuck. So that's what we're tackling next. This is usually where most tutorials get super vague, but we're not going to do that. Let's break down 3 specific account types ranked by how most people should probably approach them.
Number 1, the 401k match. If your employer offers this, consider it step 0. It is a guaranteed, immediate return on your money before the market even does a single thing. It's literally free money, and you're leaving it on the table if you skip it. Next up, we have the IRA. This is your own personal retirement account, no employer needed. Right now, IRS limits let you stash away around $7,500 a year, whereas those 401k limits hover closer to $24,500. Finally, if you don't max out either of those, or you just want to invest more freely, that's where a regular taxable brokerage account comes into play. You definitely get fewer tax perks with this one, but there are 0 restrictions on when you can actually touch your cash.
And guys, here's the part that is just so incredibly cool, and it surprises a lot of people. You do not need $600 to buy one single share of a fund anymore. Thanks to fractional shares, just $25 can buy you a slice of that exact same fund. So the dollar amount you start with, it's almost never the actual obstacle. Okay, so now you know the accounts and you know the fund. But here's the trap that costs beginners way more money than anything else we've talked about, and honestly, it's probably not what you'd guess.
Get this. Investors who tried to perfectly time the market and ended up missing just the 10 best trading days over a 30-year stretch, they ended up with 54% less money than the people who simply stayed invested the whole time. Miss the 20 best days, you've got 73% less. And if you miss the 30 best days, you end up with 83% less money. Nearly your entire gain just completely wiped out. And that is purely from missing 30 days out of literally thousands. Crazy, right?
And here is a behavioral insight that's kind of unsettling, but it is absolutely crucial to grasp. Those absolute best days in the market, they almost always land right after the scariest, worst days. Like exactly when everyone else is totally convinced it isn't safe to invest yet. Look, I get it, the market can definitely be intimidating. But if you are waiting around for things to quote-unquote feel safe before you start, you're not actually avoiding risk. You are just guaranteeing that you'll miss the recovery.
But here is the ultimate relief. The fix here isn't magically predicting those best days, because honestly, nobody can do that. The real fix is removing the guessing game entirely through a strategy called dollar cost averaging. That's a fancy way of saying you just invest a fixed amount of money on a strict, fixed schedule, completely regardless of what the market happens to be doing that week.
Let's make that a bit more tangible. Say you put $250 a month into an index fund for 10 years, hitting the market's historic average. You'd personally contribute $30,000 total, but you'd end up with roughly $51,000. About 21 grand of that is pure automated growth. You never had to predict a single trend or perfectly time the market. You literally just had to show up on schedule. Now, I know exactly what you might be thinking right about now. I don't have $300 a month to spare, and I definitely don't have 24 grand lying around to max out a 401k. But here's the really reassuring truth. You don't need to hit the max. Literally nobody starts at the max. If all you have is 25 bucks a week, which comes out to $1,300 a year, it's still in the market, it's still compounding, and most importantly, it's doing the one thing that actually matters. You're starting.
Because you see, the gap between someone who starts small today and someone who waits around until they have enough money, it isn't actually a money gap at all. It's the exact 10-year, $1.2 million gap that we open this explainer with. Waiting for that perfect amount of money to magically appear is exactly how you guarantee the absolute worst outcome.
So here's that blueprint I promised you earlier. The exact order you need to do this in. Step 1, go open a brokerage account. Pretty much any major one works, and it takes like 10 minutes tops. Step 2, inside that account, buy one low-cost fund that tracks a broad index. Boom, the entire what do I buy question is answered. And step 3, just automate a fixed amount on a fixed schedule, and whatever you do, don't touch it. That is dollar cost averaging running entirely on autopilot. Now, if you want to see exactly where this money goes once it's actually working for you behind the scenes, well, that's a whole topic for our next explainer.
Look, the math is crystal clear, and you've got the 3-step blueprint right in front of you. The gap between your current checking account and your future wealth isn't about hunting down the perfect stock. It's just about time. So the only real question you've got left is this: what is genuinely stopping you from taking that 10-minute first step today?